In one of your recent webcasts, I heard that you've become reactionary more than anticipatory.
Yes, exactly.
And could you tell us reasons why?
Yes.
Was this always the case, or has it become recently?
Wow, that's wonderful. Yes. I'd say in the last year and a half, 2 years, I've been more, and there are two ways of forecasting the market. Do all your homework, the economic, fundamental, quantitative, and technical homework. You have all this data, then you forecast. Well, given this data, I think the market's going up 10%.
Right.
Okay, that's anticipating.
Yes.
There's so much confusion. I've been in this business 50 years, actually 52 years. I have never seen so much global confusion in my life. We'd start with Brexit, start with the tariffs in China and the United States. Good God. We got a president that puts out tweets that could affect the market any second. We have people in the United States who are running for president next year, and they're socialists. What's happening? And we get this stuff in Venezuela, Iran, I mean, North Korea with missiles. I don't know, and I don't think anybody else knows what could happen tomorrow, given any of these situations, because it could get bad. So I'm saying to myself and to my audience, I said, I will react to what the market's doing. I'm not going to anticipate. If the market starts moving up and I see a lot of volume and I start to see a sector analysis improving, I'll go with that. In fact, the last month and a half, I've been encouraging the family funds that I talk to start looking at global markets.
Okay.
The French market, your market, every market is starting to move up. It's not just the U.S. market. Interesting. So it's a global affair, and I am optimistic. But I'm always watching, because I know we have, so that's me being, I think, being prudent.
Absolutely.
Yes.
In the charts which you displayed during that webcast, you used relative strength as an indicator.
Yes.
Do you think that makes more sense than the traditional RSI or MACD?
Well, the chart that I had, that's comparative relative strength. I'm taking the stock versus the market. Okay.
Yes.
And I do that because people want to outperform. Most people want to see what their performance is.
Yes.
I mean, I don't live and die by that, because when you talk to individuals, if they're making 10% a year, they're happy. If the S&P is up 12%, it's okay, as long as I'm making money. So price, I want to see price, of course.
Yes.
But when I'm dealing with more sophisticated audience and performance is important, I have to look at that line. So I do it for two reasons. Because this market's still dominated by a lot of institutional money.
Yes.
And if that line, that relative line, starts turning up, they have to participate in that. So I look, and most recently in my recent market calls, I get back into the financials in the United States, because they hadn't been doing well, and the relative is starting to pick up, technology, and so I'm reactioning. I'm not anticipating. I'm going with the flow, as they say.